Introducing SilverBiotics, the preferred colloidal silver supplement of the doc. See SilverDoctors.com for details and special promotional offers today, including a specially formulated 30 parts per million, only available from the doc and other healthcare professionals.
This is the Doc and Eric Dubin with the SD Weekly Metals and Market. Well, Eric, you pointed out the statistic on last week's show that since gold peaked last October and QE to infinity was announced, the metals have been hit with down days on Fridays 25 of the last 35 weeks, or over 70% of the time. That manipulative trend sure continued today, as both gold and silver were smashed nanoseconds before the official non-farms payroll was released at 8:30, with gold down nearly $40 at one point to $13.75, and silver down over $1 to $21.50. The sell-off continued in the thinly traded access market this afternoon, with both gold and silver closing well under $1,422, setting up potentially another test of the lows seen back in April of $13.20 in gold and $20 silver in Sunday's coming Globex session. So what's your take, Eric, on the metals this week and another smash on a Friday?
The Friday is no surprise. In fact, if I recall correctly, there's only been one Friday non-farm pays report that has been positive in the last 35 weeks. So the number for Fridays overall is north of 70%, but the number when it also corresponds to non-farm payrolls release, where MOPE goes into high gear, probably is above 95%, frankly. I mean, I haven't done the math. I should check it at some point, but needless to say, the non-farm payrolls report, period, both leading up to it in the 24 hours or so in advance of its issuance and then thereafter, is probably the single most frequently used period for cartel bombing of precious metals that we've seen in this entire bull market over 12 plus years. Zero Hedge published a nice chart today that we'll include in the write-up where people can take a look at the link and see it. And it's very clear that around a large number of gold contracts were front-run sold in advance of the report within seconds before the report was issued. So, I mean, there's only two things that can account for an action like that. It's either the gold cartel doing their thing, or the well-trained Pavlovian dog phenomenon that we've been talking about, where the hedge funds have now understood that this gold cartel phenomenon is going on, and they just pattern their trades accordingly to make a quick buck. Nobody can make an argument other than those two instances, and both of them smell to high heaven. It's a little disconcerting that we had this crash on Friday and how we compare that to, say, back in the April 12 through April 15 setup smash. Back then, the real damage was done on the Sunday and Monday following, and it looks like the cartel is actually attempting to do the same thing this time around. China is going to be closed Monday, Tuesday, and Wednesday. That allows the cartel a lot more leeway to basically trash paper markets with less fear of the physical market uptake that China and India and other buyers in Asia and the Middle East are undertaking as the paper markets are crashed. This whole paper crash strategy that the West has. Sunday evening, real test is going to be whether or not we have a similar kind of bounce that we had back on, I believe it was May 20th, when silver was attacked to the point of almost busting $20, but then ricocheted off like a rocket. That was a pretty telltale sign that the hedge funds had had enough, that they didn't want to take on the additional risk of going short even further, given the risk rewards associated with taking on new short positions. You noticed some interesting sales trends with respect to SD Bullion, and it speaks to people looking at the physical market now in the West as a buying opportunity.
With SD Bullion, we've been seeing here on the state side, and you touched on just the massive physical demand in Asia, posted up as a chart of the day. I think it was either Monday or Tuesday. Chart Bloomberg posted over last weekend showing that physical gold premiums in Shanghai spiked from $7 an ounce to over $120 an ounce in late April. This is Bloomberg showing physical in Shanghai. But to your stateside, Eric and I were chatting before the show here tonight. Really the last 3 or 4 weeks, physical sales, retail sales here in the U.S. have been down quite a bit. Demand has dropped quite a bit from the last big sales rush was early May. All the major wholesalers we deal with have pretty much confirmed that across the board. bullion sales for both gold and silver, but particularly silver, have really fallen off the table over the last 3 to 4 weeks. But today, really as soon as silver broke 22 to the downside, orders were coming left and right. Phones were ringing off the hook. As I mentioned to Eric, we had more sales today just on Friday than we've had in the past 3.5 weeks. So massive demand popping up pretty much immediately as 22 is breached. The cartel does intend to try to take advantage of 3-day holiday over in China on Monday through Wednesday. Look for the premiums to spike up again here in the West and the U.S. as physical demand just jumps back to life if we do approach 20 or break it to the downside in silver. I wanted to touch on one other thing. Eric had mentioned pure propaganda the non-farms payroll beat was today. Most SD readers are well aware of how the government manages expectations with sentiment in the payroll reports and how they always beat expectations and are then revised downward. But I wanted to touch a little bit about a story that I think was one of the biggest stories of the week. The CME Monday began adding a disclaimer to their physical gold and silver inventory reports that they are not liable for the accuracy of the physical metal holdings claimed by the banks. And I'm going to read the disclaimer out here. It says, "The information in this report is taken from sources believed to be reliable. However, the Commodity Exchange Inc. disclaims all liability whatsoever with regard to its accuracy or completeness. This report is produced for information purposes only." So as we discussed on SilverDoctors when we released the story, the CME is essentially attempting to claim that legally this report is meaningless and the banks can fully fabricate their gold and silver inventory data. And Eric, can you imagine trying to fill out your taxes and submit it to the IRS and including that disclaimer that you disclaim all liability whatsoever with regard to the accuracy of or completeness of the report? The CME is basically admitting that the bank's numbers, whether it's Brinks, JP Morgan, Scotia, they're admitting those numbers are not audited by the CME. They're just taken for face value of whatever the banks submit. So when you think back to the last 12 months with the LIBOR scandal, does anyone really believe that JP Morgan was on the up and up and submitting 100% accurate LIBOR rates when Barclays and some of the other banks weren't?
Yeah, they definitely were colluding.
If you really looked into the story, some of the Barclays traders were reprimanded for not submitting good enough LIBOR rates compared to JP Morgan and Bank of America. So if anything, Barclays didn't do enough of the fabrication of the LIBOR data. So really, this is a pretty big admission by the CME that they have no oversight whatsoever. There's no auditing of the inventory statistics, and as Jim Sinclair first stated probably a month or two ago, they're really just likely made up, and there's really no more reason to believe them than there is the bank's LIBOR reporting.
It's true, and frankly, I've never really used COT numbers, commitment of trader numbers that are produced by the CME as a primary tool. It's been more useful to look at it in terms of confirmation of what trends are going on from a broader perspective. So I'm not as wed psychologically and for that to these numbers, and for that matter, there's actually a lot of analysts that make their daily bread by following COT, and it's the majority of what they do. And there's a lot of resistance as a result to questioning these numbers. But the bottom line is that the CME has never done any kind of audits or attempted to make these numbers guaranteed in terms of their presentation under their umbrella. It's always been just taking the numbers directly from the JP Morgan, Scotia Macatas, and the bullion banks of the world and reporting them to the public without much fine-tuning or analysis. It's just whatever the bullion banks want the world to know, that's what the bullion banks report, and the CME is acting as a relay station and nothing more. So it's telling in that this disclaimer has appeared, whereas it hasn't been there all this time. And you got to ask the question, why? And it's the legal liability of the possibility of the comics maybe defaulting or just going through a period where people might sue based on not being able to get an allocation, physical delivery, or what have you, is increasing in risk, and that's part of what I refer to when I speak about the fact that the cartel can do what it pleases, but it comes with a cost. One of the costs may in fact be the demise of the COMEX and the LBMA. Certainly from a confidence point of view, they've already taken massive hits. In this post-MF global world, a lot of people are looking with a jaundiced eye at these institutions, and they frankly just don't trust them. I mentioned last week that the bond market's beginning to back up, and today we had an over 4% increase in the rate of the 10-year U.S. bond security, and that's pretty big as far as single-day moves go. We have a very unstable financial system. Federal Reserve is taking down at least 70% of the long-term bond issuance at this point, and there are periods where it gets to as high as even 90%. We don't have the same kind of relationships with Japan and Saudi Arabia and China, where they used to buy a huge amount of our long-term bonds. And all this nonsense talk about tapering and pulling in the ability of the Fed to buy, and how this is used as a propaganda song and dance to manage the stock market and thereafter other markets is something that just can't continue indefinitely. I mean, even if they did manage to taper for, like, say, a 20% reduction or 30% reduction, we're still talking about hundreds of billions of dollars on an annual basis increase to the balance sheet of the Fed. And there's a lot of talk as well about how in the long term, the absence of a velocity of money increase and paltry levels of consumer inflation are signs that this sequester of money in the balance sheet of the Fed, shall we say, is not having a huge impact to inflation, and therefore, the gold bugs are all wrong and silver bugs are wrong. But the point is that if you actually look at the Fed balance sheet on a chart basis, say 10 years or so, just look at a big picture and compare it to the price of gold, the correlation is ridiculously high. I mean, it's like over 90, it's over a 9 score, 90% correlation. So in the long run, what the Fed does in terms of taking on greater debt matters. It doesn't have an immediate impact in terms of how it filters into the economy and whether or not banks are lending aggressively and whether or not the man on the street is nervous about holding currency in their pocket, and therefore they're willing to spend faster, and velocity goes higher, and inflation in turn responds. All of that stuff in the big picture is not the critical point. The critical point is that debt is increased, and we thereafter have a response in terms of what the true value of gold and silver are, which are hard assets that respond to a depreciation or debasement of currency.
Let's go back a little bit and touch on the capital control issue, because there's several pretty big stories and issues that popped up just over the last week globally as far as capital controls against gold. Obviously, we had the big story in India earlier in the week. They increased the import taxes another 2%, I think, for the second time this year. And then the very next day, the finance minister sat down with the head of the banks and advised them against selling physical gold bullion to their retail clients, and even went so far as to advise them that they need to propagandize their retail customers against purchasing the barbaric relic. That big story in India, and really breaking about the same time, was the news that effective a week ago, June 1st, France has blocked all postal shipments of physical gold, silver, bullion, as well as jewelry, and also cash. The capital controls are expanding globally. Look, in the next couple of years, don't be surprised to see capital controls here in the West, and Canada and the U.S., restricting the movement of capital, including targeting gold. I'd look especially for that to be against those held in accounts and not in your own possession, but they're going to tighten the noose as much as possible and attempt to corral all of the funds before they burn the house down. So he who panics first panics best is really the classic saying that applies here. Time to avoid capital controls is before they're enacted, outside of going around it via smuggling or other things like that. But the easiest and safest way is to avoid capital controls is to preserve your wealth and move your capital before the capital controls go into effect.
Totally agree. I mean, that even makes an argument for owning some portion of one's assets into mining shares, and I know that that's a somewhat controversial subject for some folks that are stackers, and even the folks who call themselves free gold advocates, who believe that the price of paper gold is going to go to zero, which if the comics were to just evaporate and disappear, and there are other paper markets up and running in Shanghai and Dubai and so forth, price of gold is not going to go to zero. I think that this whole notion is kind of silly. The cartel cannot bring prices in the paper world to a negligible point. That there is a limit to the damage that they can do, and as a result, the likelihood that precious metals equities would be able to at least hold some value over the long term, assuming that the market doesn't completely go into a state of suspended animation for many, many months, if not a year or two, in this lull that we're going through right now. There's a place in one's portfolio overall to hold precious metals, to hold precious metals equities, and diversify as much as possible. Owning gold, silver, oil, farmland, if that's something that's feasible for a lot of people, in fact, that live in the Midwest, they in fact live on farms. So it's not the easiest asset class to invest in, but in the sake of diversification, it is possible to do things like that. When the bond market comes under further pressure, and I can't see any scenario at this point other than the Fed increasing its purchases of bonds for the bond market to be friendly to further rises in equity prices. At some point, if we get at, say, 3%, 4% for the long bond rate, the economy is going to roll over. The very tepid rebound that we see in housing is going to roll over. And eventually the stock market is going to come under pressure. And when people see that scenario, they're going to look around and say, well, what do I do with my money? And one of the places where people will begin to return to in the Western markets will be gold and silver. Fundamentals haven't changed. This is like a game of poker where they're willing to just go for it and see what happens. And that's a poor excuse for public policy and economic policy, and in service of trying to maintain this extend and pretend bond market illusion that we have. But that's where we are. They need to don on their hard hat and get ready for flack, because it's coming.
So in a recap here, we have the real risk, another cartel spike low in the Sunday night Globex session. As China closed Monday through Wednesday, we wouldn't be surprised at all to see the cartel try to take out the April lows in gold at $13.20 and silver at just about at $20 even. But again, the long-term trends, the fundamentals have not changed. If anything, they're only getting more bullish by the day, with bail-in policy really becoming concrete across the West. For the next banking crisis, the bail-in policy will be pursued. Just in the past week, the rapid expansion of global capital controls targeting gold. Should be another interesting week. And for Eric Dubin and the Doc, thanks for tuning in to the SD Metals and Markets.
SD Bullion.